Hi everyone, my name's Imran from Modus Academy.
And I'm Emelie.
And I'm Nana, and we are from Miracle Properties. And today we're gonna cover the pros and cons of bridging loan.
Pros and cons of bridging loans. I guess it'd be helpful to start explaining just for everyone to understand. For those who don't know, what is a bridging loan, I guess, more importantly, because, I think we did a video on mortgages, and people understand what a mortgage is. So a bridging loan in essence is where you might want to buy a property that requires possibly a quick purchase in the UK. So it could be maybe a seller's distress. They need to get out of that deal. They're going to lose the home because they're going to be repossessed maybe by the bank, or it's in such poor condition that you couldn't buy it with a mortgage. I mean, you buy properties as well, like we do, and you do them up to a really high standard. So a traditional mortgage may not work. So it's about quick access to finance is probably the simplest term to explain it. Would that be a summary?
Yeah, I think so.
Yeah. Good.
And like you said, if we're going to start off with the pros, because you mentioned some of them already.
Yeah.
We start off with that.
So what did we mention? I guess speed and quickness of a bridging loan. So you can get a bridging loan relatively quickly. I mean, the actual bridging concept was built mainly around auction finance. So if you're buying a property from an auction, you would normally buy it within 30 days. From the moment the sort of hammer goes down, you'd have 30 days to complete. So to get your sort of things in order, I was going to swear, but I won't. To get your things in order, you need to make sure that, you can get your bridge in place, and a mortgage would take longer. A mortgage, you might be looking 8, 12 weeks to get through, whereas a bridge, you need it done in 4 weeks, and that's the opportunity. So I guess quick is good for auction purchases. Would you guys say it's good for flipping as well? What are your thoughts on that?
Yeah, I think if like you mentioned, let's say, they usually say when you buy a property and you do it up, everything will take around 9 months from start to end. So if you maybe put a bridge on 1 year or even 2 years, because you get back the money when you repay the bridge loan. So just to be cautious, you can do that way.
You can buy yourself some time, basically, which is good.
Yeah.
And we mentioned, obviously, like you said, if you're doing a property up, like we mentioned, so it's good for financing poor condition properties, non-mortgageable properties. I mean, that's a crucial one, isn't it? So you guys and I have seen over the years, properties that are pretty stinky inside, and some properties which a traditional bank just will not touch. So it's those types of deals where bridge lenders are more open to, I would say.
And also, like Nana said, when it comes to flipping, like you should always think that you make your money when you buy the property, right? And in a lot of cases, you can, if you have cash, or you can complete the deal really quickly, you can maybe get a better price on it.
Yes.
Yeah.
And that's where the bridge come in, because it goes quickly, like you said before. So that's one way you can use it when you do a flip.
Yeah, I love that. You're absolutely right. Like, you make money when you buy is an absolute true saying. And because if you can negotiate and get sort of 5, 10, 15% extra discount on the purchase price because you're in a position to move fast. And I've always seen a bridging loan almost like cash anyway. I've always sort of in my mind thought that it's basically like an extended arm of lending. Yes, there's some process you have to go through, but it's there and accessible to you. So yeah, I think that's a really good one. I think it's also good for bigger deals. So if you want to do sometimes a bigger deal, then you might need to go down the bridging route, because the structure of the deal, it might be a bit more complex. And again, if you went down the traditional mortgage route, the traditional lender might say, okay, this deal doesn't tick any normal box that we have, so it doesn't comply. But a bridge lender, I guess, and the broker behind that lender is looking at the overall package, the overall deal. So they would take a much more, I think, open approach to it.
Yeah, and also in those cases, you can also get the loan based on the gross development value, the GDV, in the end.
Definitely.
And then you get more money out, of course. Yeah. So they look at it in a different way than normal mortgage lenders.
I think that's an excellent point because, and this is something for everyone to really understand. The great thing about versus a bridge loan possibly versus a mortgage is sometimes a mortgage you'll get, say, up to 75% of the purchase price of the site or project, whatever you might be doing. Whereas a bridging loan, they may, depending on the project, let's say it's a conversion of a property into multiple apartments, they might give you a percentage of the purchase price, but also a percentage of the build cost. So you are getting basically a much higher loan if you feel comfortable doing that, which means you need less of your own capital to go into that deal. So it can make deals possible for you. And people will sometimes put off big deals because they don't think they've got enough cash when actually this could be a solution for them. Really good point. I think also newbie investors, you know, we always talk, you and I, we always talk to people that are kickstarting their journey and they go, well, how am I ever going to get any lending in the UK? I've got no track record. Bridge loans are definitely an option, aren't they?
Yeah.
Newbies.
It is.
Yeah.
Good. You should just calculate it right.
Yeah.
It's all about the numbers and being cautious because you don't want them to grab that property from you.
Yeah. And that's probably a good point to start talking about the cons of a bridging loan, because grabbing the property off you is something we need to consider. So what would be cons of property? I guess cost is probably the biggest factor. So I don't know if you've spoken to, because Nana's spoken to, I think, every mortgage financial broker in the country. I mean, what sort of prices have you been quoted before?
So the thing is, me and Emily, we have like this temple that we do. So let's say if you get like a bridging on 70%, then we take off 10% as cost because it differs from everyone. Some have like entry fee, exit fee, arrangement fee, and it can be different.
Yeah, and most of when it says it's going to be different, when with bridging finance, you often, not all the time, but often pay upfront the interest rate, the exit fee, all of these fees that comes with the mortgage. They take that off the loan, and then they pay it out. So if you get loan to value 70%, you won't get out 70%. That's what it means. So we calculate on getting 60% out of the loan if we get a loan to value of 70%, for example, in that way. But we have a template, like Anna says, absolutely. We have been given rates between 0.75 a month up to 1.25. It's a very variation between all of the lenders and all of the brokers that we've spoken to, and even during uncertain times like we are in now, the rates go up and down and the loan to value up and down.
Yeah, exactly. It just depends on the risk, doesn't it? It's the risk that the bridge lender sees himself in. And again, you made a good point there that actually, whenever we do our calculations, if you're running it at 70% loan to value, the bridge lender might say, hey, rather than me take all the risk, I'll take all the interest that I was going to charge you each month of that 0.75% to 1.25%. I'll take it. If you need it for 9 months, I'll take all that money up front now, and I'll give you a net amount of money, which is less in effect. So it does mean you always need a bit more cash to go into the deal. You need to be aware of that when you're doing this. So don't assume that you're going to get the full 70% loan to value on a bridge. Really good one.
So that's one of the cons. Like it costs money to use bridging finance, but as long as you do your calculations correct and you have enough margins, you can use bridging finance. It won't be an issue. But like Nana said prior, make sure that you keep the time frames because you will get penalties for not repaying.
Exactly. Yeah, you buy more time. So if you're taking out a bridge loan and you're doing a flip and you think it's going to be 6 months, buy more time, have it for 9, 12 months, because a lot of the bridge lenders will also give you flexibility on if you repay early, then there may be no further penalties to pay or nothing to pay because you're repaying early. They probably would respect you and like you for that. And again, you're building a good relationship with a bridge lender. So buy more time is so crucial when you're taking out sort of a higher interest rate loan.
It's always about relationships. That's the thing people forget about this property game. It's about relationships with the banks, with the lenders, with the bridging, with the builders, with the sourcers, with everyone. The better relationship you have, the better your business will go.
Exactly. The better, you know, cash you'll have access to, the better lending opportunities, you'll just build much stronger relationships. Relationships is everything around property. And I think that's why I probably love it so much, because it is a people business more than anything. Numbers and everything else is very important behind the scenes, but this is exactly why it works. So bless you.
Sorry, you will need to cut that out. That's why I say wait.
She's letting it out, which is fine. That's fine. This is the joy of where we film these. Okay, we all catch colds during this time, so Emelie's letting it out today. So I guess one key thing is the fact that these bridge loans, I guess, can kill deals. So that's one thing to say, that a bridge loan can kill a deal. It could end up being, you know, too expensive to make the deal work. So I think it's really important that when you're running numbers on deals to really be sure that that particular deal is the right deal for your bridge. Would that be a fair comment, guys?
Yeah.
Yeah.
Exactly.
Like you said, just do the numbers to really make sure that you are able to do it, but don't be afraid of it.
Yes, don't be afraid. Exactly. Don't be afraid of bridging loans, because it can be really good. You just need to be really clear, have a clear finance exit plan. So be really clear about what your exit plan is with a bridge. You know, you're going into it and always see a bridge as short-term finance. Never see it as hey, this is like basically like a mortgage. It's not. This is about getting in the deal, adding value through refurbishment if that's what you want to do, and exiting onto long-term finance. Yeah, getting in and getting out basically of the deal.
Also, like you said, when you talk about finance exit plan, make sure you have that in place before going into it.
Yeah.
Even if it won't be valued in 12 months time, you might need to talk to them after 6 months and make sure it's still there and everything like this. But always have that in place before, so you have spoken with them. You know what you're gonna do. They are on board with what you think and what your plans are. So you have that prior.
Definitely, because the more prepared you can be with this type of structure, this type of strategy, and the way you're doing deals, the easier hopefully your journey will be when you're investing in property. So absolutely that. So cool, very good. So anything else to consider? I think there's some good pros and cons in there.
Yeah, it is. And then for example, me and Anna has been looking into bridging a lot, because we said earlier, if you can make your money last longer by using bridge. And one way that we've been looking to do it, because if you do it on bigger projects like you spoke about, Imran, they can lend on the building cost and stuff like this.
Yeah.
The margins is better. If you do it on a normal buy to let, the margins might not be as good if you do it straight away. But one way that we've been looking to do it is to buy the first property cash.
Yeah.
And then when we're gonna buy the second property, the second buy to let property I'm talking about now, then we use a bridging, and we will have bridging finance on that house, but also use the first house, which we own 100% of, as a security. So we will get 100% of that value, which will hopefully be a lot since we refurbished it and it's looking nice. So we will get 100% of that value, and then the purchase price, loan to value of the second home. So we get out more money on the bridging finance, can use that for refurbishment and stuff like that, or maybe just use it to buy 2 properties instead of 1.
Yeah, so you want to spread your risk over multiple assets, which is good. And that's the thing, you could use a bridge loan, some other types of commercial finance where you've got that initial asset, and that's quite a good idea. You use the initial asset as generating more leverage back out, so you can then spread your risk over multiple units. So like that, really cool. Good question around pros and cons, I guess, because people are scared naturally around from bridging loans, but it's really good just to give an overview of what we like about them, what the challenges are. But I think if you run your numbers correctly, do your due diligence, have that finance exit plan like you said, then you should be onto a pretty good thing, hopefully.
Yes.
Awesome. Great question. I love that one about bridging loans. So if you haven't already, please subscribe to our YouTube channels. Please share these, I guess. Let people know that we do these, because we really enjoyed making them happen. We do have fun, don't we, guys, on doing this? So please get them out there. So thank you so much, guys. And really good question as well.
Thank you. Bye.
Take care.
See you guys soon. Bye, guys. Bye all.